Here's the ugly little truth nobody likes at cocktail parties. Winners are rarely the smartest people in the room. More often, they are the ones who refuse to quit. They show up tomorrow. They keep their heads when others lose theirs. They make fewer foolish mistakes, and they survive long enough for compounding to do its work. Call it luck, call it fate, but most of the time, survival trumps brilliance. I say that as a man who grew up with the Great Depression as a background hum. You don't need a lecture on history to understand what that does to a psyche. But you do need to understand the daily arithmetic of scarcity to see why the habit of surviving becomes a competitive advantage. My parents and their neighbors learned to hate debt. They learned the difference between what you want and what you can afford to keep. Those lessons are boring. They are small. They also turn out to be extraordinarily useful when markets are noisy and clever people are busy proving how clever they are. When I met Warren Buffett, the contrast between flash and endurance became even more obvious. People expect some mythical chemistry that makes partnerships succeed. There is chemistry, but it's not glamour. It's a shared set of values, the discipline to avoid unnecessary risks, and a tolerance for long, slow processes. Warren was patient. I was practical. Over the years, we built things in ways that rewarded that patience. It wasn't genius so much as a tolerance for time and a preference for not being stupid. Let me give you a clearer picture. Imagine two men at the starting line. One is brilliant, full of tricks, convinced he's figured out the secret shortcuts. He sprints off, dazzling everyone with a string of impressive moves. The other plods along, steady and deliberate. At mile 5, the sprinter is exhausted, having spent energy on showmanship and reckless bets. The plodder keeps the pace, tolerates discomfort, and keeps making small, smart choices. When the months and years pile up, the steady one has simply outlived the flashier player. That's the point. Time is the silent partner in most successes. If this sounds ordinary, that's because the ordinary works. There's a romance to a lightning strike genius in our stories, but in real life, the snowball beats the lightning bolt. Compound interest, whether it's money, reputation, or skill, does its work slowly until one day people look around and say, "How did this happen?" It often looks accidental because the process that made it happen was boring and relentless. Before I go further, if you like clear, no-nonsense lessons about how to think for the long term, subscribe. I don't offer secrets. I offer hard-won, plain advice that pays off if you follow it for years. Now let me place a few scenes in front of you. First, my childhood and what it taught me. Second, a partnership that proves the point. Third, a few vignettes of people who chose drama or pride over patience. Those stories are not here to shame anyone. They are cautionary models of error and, in one case, of the quiet success that comes from ordinary discipline. I remember our family's kitchen table as a ledger for decisions. Not literal ledgers, just a mental accounting that kept you from doing something foolish. In the Depression, you learned to look at odds. You learned that if the downside could ruin you, you didn't take the so-called clever move. That lesson built an instinct for survivability. It is not glamorous, but it is a better starting point than brilliance without breaks. That instinct shaped how I looked at investments and businesses. I learned to dislike leverage. When you borrow to magnify returns, you also magnify the chance of being thrown out of the game. And if you're thrown out of the game, your intelligence on paper means little. You are no longer compounding. You are no longer participating. In markets, the most important skill is not being knocked out. Which brings me to Warren and our long partnership. We didn't find each other because we were looking for flash. We found each other because we shared an operating philosophy. Be rational, be honest, don't be fooled by fancy stories, and don't make decisions that can end you. We complemented each other. That's crucial in any long relationship. One partner's strength is often the other's correction. I'm not going to romanticize it. We had fights. There were times when I held on to mistakes longer than I should have. There were times he had to rein me in. But the partnership had a kind of mutual brutal honesty that prevented us from getting infected with our own cleverness. I must be candid about personal mistakes. I held businesses far too long because of emotional attachment or ego. There were ideas I loved and defended long after the evidence turned against them. That's not a confession for drama's sake. It's an admission of how easy it is to confuse persistence with righteousness. Blind persistence can be the most dangerous persistence of all. Anecdotes about other people can be more instructive because they give a clean line between cause and effect. Take the man who lived next door in my youth. Status mattered to him. He wore finer clothes, bought a bigger car, and took pride in being perceived as successful. But the money he spent to buy that status came from borrowing and risky bets. He was fashionable in all the worst ways, quick to borrow, quick to compete, slow to learn. When the wind changed, he had nowhere to hide. That envy didn't make him happier. It made him poorer. Or the lawyer I once knew who thought margin was a shortcut. He believed the market owed him returns and used borrowed money to chase them. For a while it worked. The gains fed his confidence, and his friends pointed at him like he'd discovered some talent. Then a correction came, and the leverage did the work of a bulldozer. He lost not just his gains, but a lot of his principal. It's a pattern I've seen more than once. Leverage magnifies stupidity. It doesn't distinguish between genius and folly. It simply amplifies error. And then there's the quiet person whose life looks uneventful on the surface, but who, decade after decade, saved consistently and put money into sensible places. No headlines, no dramatic wins. But years later, the compound effect made them rich by ordinary means. That quiet accumulation is rarely inspiring at cocktail parties, but it creates the substantial outcomes in life. Boring works. Regularity beats the occasional cleverness that collapses under its own weight. From these scenes, a few rules suggest themselves. Rules that are less about secret formulas and more about consistent habits. I'm going to put them plainly, because people like plainness in matters that compound. First rule, avoid envy. It's corrosive. Envy makes you compare your insides to somebody else's outsides and then act. The actions envy produces, overspending, risky bets to show off, keeping up appearances, are mostly losing propositions. Envy is not just a moral problem, it's an economic one. It prompts you to take downside-heavy gambles to chase an appearance. Second rule, avoid debt when it's used to fund lifestyle or speculation. There is responsible leverage, responsible borrowing for productive investment. But most personal use of debt is a one-way ticket to stress and ruin. Debt narrows your options. It shortens your time horizon because obligations come due whether you're ready or not. Time is the axis on which compounding works. Don't cut short the axis by using other people's money carelessly. Third rule, avoid drama. Life is full of noise, market panics, media hysteria, self-appointed gurus. Drama encourages short-term thinking. It persuades you that something urgent must be done now. It usually doesn't. Calm judgment beats dramatic action. If you can keep your mind clear while everyone else is yelling, you have a serious advantage. Fourth rule, avoid fools and foolish ideas. The company you keep matters. Not every brilliant-seeming person is a good partner. Some people are charming or persuasive, but they lack prudence. Associating with them increases the chance you'll pick up foolish bets. Choose partners who value honesty and share your time horizon. The right partner will tell you when you're mad. The wrong one will egg you on. These rules are, at heart, defenses of the simple idea that staying in the game is half the battle. But there's an important caveat. Persistence without versatility is a trap. Persisting in an error because you've already invested time or pride into it is one of the most destructive forms of persistence. The key difference between persistence that wins and persistence that ruins is rational adaptability. You must persist in the right things and have the humility to abandon the wrong ones. To persist means to endure and to learn. Let me unpack that paradox. Persistence is necessary because time magnifies tiny differences. Persisting with small advantages allows them to compound into large ones. But persistence is hazardous when it becomes a loyalty to error rather than a loyalty to truth. The smart way is to persist in principles and change in particulars. Keep the habits that favor survival and long-term advantage, saving, avoiding leverage, thinking in probabilities, but change your specific gambits when facts change. Learning how to change your mind is one of the least glamorous but most valuable skills. It saves you from falling in love with your mistakes. It requires admitting ignorance in public, which is hard for most people because they conflate insecurity with weakness. But the opposite is true. Humility in the face of uncertain facts is a form of strength. If you can say, "I was wrong," you save yourself a lot of unnecessary losses. That's a habit worth cultivating. Another practical distinction worth making is the difference between thinking like an owner and thinking like a careerist. A careerist chases the next quarter's applause. An owner thinks in decades. Owners care about franchises, about goodwill, about steady cash flows, and sustainable advantages. Careerists are often optimizing for short-term metrics and the next performance review. If you want the benefits of compounding, start by adopting an owner's mindset. Ask how a decision looks after 10, 20, 30 years. Small, prudent choices accumulate into predictable benefits over that arc. Buy quality. It's not a flashy line, but it's true. A good business or a good decision that you can stick with will outperform a series of bargains that require constant tinkering. Cheap things often need expensive upkeep. Quality saves you friction costs and surprises. It frees your time and attention for other compounding activities. Thinking like an owner means you care about durability and margin of safety. I'll give you another practical image, the snowball. Start with a small ball of savings or skill and roll it downhill. At first it's tiny. You can pick it up and toss it if you want the quick thrill. But if you keep rolling, it gathers mass and momentum. A little often beats a lot occasionally. People underrate the value of regularity because it lacks drama, but consistent behavior is the linchpin for compounding. By now, you might be thinking, how does one build discipline in a world that prizes noise? The answer is boring but effective. Systems beat willpower. Set up rules that reduce judgment calls. If you decide in advance to save a percentage of income every month, you don't negotiate with your emotions at the end of the month. If you decide that you will not use leverage beyond a set level, you remove the temptation in moments of exuberance. Habits that automate prudence will protect you when markets or people test your character. Let me shift back to a more human example because rules mean little without application. Think about a friend of mine, call him Sam to protect the innocent, who had a knack for seeing short-term angles in markets. He would find the story everyone else hadn't seen yet and buy at the first whisper. For a while, it worked. He made attractive returns, but then he leaned into success and increased his bets. He did not pay enough attention to downside. When things went wrong, the losses were large. He lost not because he lacked intelligence, but because he had allowed success to rewire his judgment, and he had used leverage to make his judgment more consequential. Contrast Sam with another acquaintance, let's call her Ruth, who earned an ordinary salary, saved a modest share of it, and invested in businesses she understood. No exotic schemes, no headlines. She avoided debt, lived under her means, and let time do the heavy lifting. Over decades, Ruth's wealth accumulated quietly. She had luck, too. Few people can control everything, but she positioned herself to take advantage of luck because she wasn't wiped out by it. That's the asymmetry I keep harping on. Survival magnifies chance in your favor. You'll notice a recurring theme. Survival requires a mixture of prudence and honesty. Prudence minimizes ruin. Honesty lets you update your beliefs. Together, they create a rare but decisive advantage. Many people have one without the other. Some are prudent but prideful, refusing to learn. Others are open to learning but reckless. The sweet spot is the combination. These are not grandiose prescriptions. They are habits. Save more than you spend. Avoid foolish leverage. Buy durable quality. Partner with people who will tell you the truth, and keep your time horizon long. They sound prosaic because they are. Their power comes from sticking to them, not from discovering them. One more point about partnerships, because it's misrepresented a lot. People think successful partners are like clones who always agree. The truth is that successful partnerships are built on complementary strengths and brutal honesty. Partners criticize each other. They force each other to see blind spots. If you want to own your time and protect your compounding, find people who will correct you, even if it hurts. Flattery is not a partnership, it's a con. Now, as we push deeper into the mechanics of persistence, you should be alert to the central paradox, the difference between persistence and stubbornness. Persistence is a strength when it is guided by feedback and a willingness to change tactics. Stubbornness is a vice when it is a defense against reality. The practical question you should ask yourself at periodic intervals is simple. Am I persisting because this is the best information available, or am I persisting because I'm committed to being consistent with my past ego? The former is an adaptive strategy. The latter is self-sabotage. That leads to another operational habit. Set review points. You don't need to change your plan at every sign, but you do need scheduled moments when you step back and evaluate whether your original reasons still hold. In business, we call them post-mortems. In investing and life choices, call them quarterly or annual reviews. These reviews are not a sign of weakness. They are a method to preserve the utility of persistence while avoiding its pitfalls. We also need to deal with statistical thinking. A lot of human error comes from seeing small samples as if they were definitive. You meet someone who made a fortune on a risky play and assume you can replicate the trick. You read a success story and treat it like proof of a method, but luck is noisy and outcomes are not evidence of skill unless the sample is meaningful. Train yourself to think in probabilities and to weigh evidence proportionately. Again, that's dull, but it works. I want to pause and tell you a brief story that lives at the intersection of these principles. Years ago, I owned a business that I liked more than the numbers warranted. I rationalized my attachment. I convinced myself of future turnarounds without admitting that the competitive landscape had shifted. I persisted for sentimental reasons, and as a result, I made less than I could have. The point isn't to dramatize failure. The point is to show how easy it is to mistake persistence for virtue when it's really an emotional commitment to a bad outcome. In that case, the right thing would have been to accept the loss sooner, redeploy the capital, and move on. The slower, proud approach cost me. That's the ugly part of the lesson. Stubbornness often masquerades as loyalty. You'll notice I keep circling back to modesty. Modesty in time frames, in expectations, and in what you allow to occupy your attention. In an age of constant updates and social spectacle, modesty has market value. It reduces the tendency to trade and react. It buys you the most valuable commodity, time. By now, you should see the skeleton of a practical playbook. Cultivate survival instincts, avoid the four poisons, envy, debt, drama, and fools. Think in decades, buy quality, automate prudence with systems, review periodically, and keep your ego in check so you can change your mind when facts change. Those steps do not guarantee wealth. Nobody can promise that. But they stack the odds decisively in your favor over time. At this point, I want to show you how these ideas play out in one more real-world contrast before we move into detailed habits and tactical rules. Consider two entrepreneurs I watched over a couple of decades. One was dazzled by the promise of fast growth and constantly shifted strategies to chase trends. She hired hotshots, burned through cash on flashy launches, and celebrated publicity. The other built slowly. He focused on sustainable margins, refused to use debt to chase growth, and reinvested profits carefully. When the market shifted, which it always does, the first entrepreneur crashed hard because her model depended on continuous inflows and attention. The second adjusted, survived, and eventually owned a steady, profitable business that compounded value quietly over years. I could give you many more contrasts like that because life is full of them. They all point to the same moral. Persistence is valuable, but only when it's applied to durable advantages and paired with a mindset willing to cut losses and adapt. Persistence for its own sake is blind. Persistence guided by rationality and modesty is a force multiplier. We are far enough into this that I should make a practical list of habits you can begin tomorrow. These are not revolutionary. They are rhythms that will, if sustained, tilt your life toward compounding benefits. I'll expand on tactics later, but start by internalizing these as operating rules. Save consistently and live below your means. Do not use margin or high leverage for speculative bets. Buy things, businesses, skills, relationships that will likely keep paying dividends for decades. Choose partners who tell you the truth, schedule regular reality check reviews, and train yourself to think in probabilities rather than certainties. All of that prepares you for the next important consideration: how to keep persistence from calcifying into stubbornness. That's where adaptive mechanisms come in. Rules for exiting losing positions, criteria for judging new opportunities, and indicators for when pride is masquerading as discipline. You need both a rule book and a referee. The rule book is your set of operating principles. The referee is someone you trust who will correct you when you're wrong. If you have neither, your chances of being blindsided increase. I'm going to pause the narrative here to set up the next phase. We've covered why persistence matters and how it often trumps cleverness. We've sketched the moral hazards that can make persistence dangerous, and we've hinted at practical habits that convert endurance into advantage. What remains is a deeper exploration of tactical execution. How to write the actual rules you'll follow, how to structure your life and money to resist noise, and how to build partnerships and psychological safeguards that help you survive and compound. Before we get there, ask yourself a simple question. Are you building to be the person who survives the decades, or are you building to be the person who wins the next applause? The distinction is the fulcrum on which everything else turns. If your answer leans toward longevity, then the rest of what follows matters. If your answer is the quick applause, then you should at least know that applause is a poor substitute for the accumulation that comes from staying in the game. So far, I've given you the theory and a few stories. Next, we'll take the practical steps, specific rules you can adopt, pitfalls to avoid when your ego wants to pretend you're a genius, and ways to assemble a life that lets compounding work rather than fight it. We'll also walk through a couple of decision-making frameworks I use when weighing opportunities and losses. And I'll explain how to set those review points so they actually change behavior rather than just make you feel organized. But before I move on, one more note about temperament. If there is a single personality trait I've seen that matters more than intelligence, it is a kind of steady indifference to the applause of the moment. It's not cynicism. It's the capacity to regard short-term noise with a shrug and to focus instead on things that are likely to be valuable in 20 years. Cultivate that temperament. It's the psychological architecture that allows persistence to operate without turning into foolishness. Now, let's lay down the first tactical piece. The topic of leverage deserves a thorough, practical treatment because it is where many people die in business and investing. Leverage is seductive because it promises amplified returns. It is deadly because it amplifies losses and often imposes timelines that force premature decisions. In the next segment, I'll walk through conservative leverage rules, alternative ways to achieve magnified outcomes without exposing yourself to ruin, and how to think about the difference between responsible borrowing and speculative margin. We'll follow that with a detailed look at partnership selection and the kinds of questions you should ask before you let someone else's judgment affect your capital or reputation. Think of this as the point where we leave the sermon and get to the playbook. The sermon is important because it aligns values. The playbook is where you convert values into repeatable habits that will keep you in the game long enough for compounding to matter. The difference between people who read an article and people who change their lives is whether they implement the playbook and keep implementing it for years. So, are you ready to go there? If you are, the next segment will be a pragmatic manual, concrete rules on leverage, a checklist for dependable partnerships, a decision-making template for investments and ventures, and a set of psychological tools to keep your ego in check. We'll also discuss specific examples of how these rules look in the real world, without glamorizing individual outcomes and without promising impossible guarantees. If you want to take the practical path, prepare to adopt a few plain constraints that will feel restrictive at first, but will reward you with optionality and time, two of the most underrated assets in life. And if you think you already have the formula because you're clever, remember this: being clever is a poor substitute for being careful. The market doesn't care how smart you think you are, it cares whether you keep playing. Before we turn to nuts and bolts, one last thought that ties back to the title. Persistence beats genius every time. Not because genius is unhelpful, but because brilliance without the discipline to preserve and compound is like a match that burns bright and then leaves you in the dark. Persistence is the battery. Genius is the flash. You want both, but if you must choose, pick the battery. Now we move into the tactical section. How to implement this battery mentality in everyday financial and business choices. How to structure your partnerships, and how to institutionalize the humility required to change your mind when the facts demand it. First, let's deal with leverage because it is where clever people get killed. Leverage is seductive. It promises faster returns, more dramatic wins, and the pleasant illusion that a small edge can be amplified into a fortune. It also imposes deadlines you don't control. If you borrow to play, somebody else sets the clock. That is the ticket to ruin. A practical way to think about leverage is to reverse the usual question. Don't ask, how much can I borrow to maximize my return? Ask, what level of loss would bankrupt me or force me to sell at the worst time? If the answer makes you wince, don't take the bet. The prudent person imagines the bad day and then asks whether they could survive it without losing the ability to participate later. Surviving is the point. If you're not confident you can withstand the bad day, you should treat the position as speculative, not productive. There are less dramatic ways to get leverage without borrowing. You can use your time like a form of leverage. You can concentrate effort on skills that compound, writing, sales, product design, rather than blowing capital on financial leverage. You can take non-financial leverage, structured equity deals, sweat equity, partnerships where you swap skills for upside. Those forms of leverage don't force you to sell when markets wobble. They let you keep compounding. A set of operating rules I have found sensible, and which you can adapt to your circumstances, looks like this in practice. Make debt a tool for productive, sustainable growth, not a crutch for status or speculation. Avoid margin for short-term bets that you cannot explain to a skeptical friend. Keep a liquidity buffer, sufficient to weather periods of poor returns. And when you do borrow, Do so with the mindset that the loan should not shorten your time horizon. Those are practical constraints that preserve optionality, one of the hardest to value assets a human can have. Now, partnerships. People romanticize partnerships as magic. Two brilliant minds creating an exponential outcome. That's sometimes true. More often, partnerships work because one partner sees what the other cannot, and both have the courage to speak plainly. Partnership selection is one of the most underrated decisions you will make. Choose people who will tell you truthfully what you're doing wrong. Choose people who have skin in the game and share your time horizon. Avoid partners who need constant reassurance or who measure success by applause. Shared values matter more than shared intellect. If you're considering a partner, ask these kinds of practical questions in advance, even if you don't use them as a script. How does this person react to being contradicted? Can they accept evidence against a cherished idea? Have they shown the habit of finishing projects and surviving lean periods? How do they handle money in their personal life? If you find charm without backbone, charisma without consistency, or immediate attempts to impress you with risky heroics, that's a red flag. The right partner is the one who will point out your blind spots and who will suffer through the years with you when nothing dramatic happens. The exact person you want beside you when the quiet months roll into decades. Partnerships also need structure. Informal understandings work until they don't. Agree on clear decision processes, on how you will split gains and losses, and on what happens when partners disagree. More important than the contract is the culture. Insist on honesty, encourage dissent, and reward those who raise inconvenient facts. Flattery is a soft form of corruption. If your partner only compliments your plan, you need a better partner or a mirror. Next, let's make decision-making explicit. The best decisions are the ones you can explain simply and defend with evidence. I use a straightforward template when weighing an opportunity, and you can too. Start with the downside. What is the worst reasonable outcome? How likely is that outcome? If the downside is catastrophic and the probability is non-trivial, you should treat the opportunity as dangerous. Second, estimate the probable return conditional on the downside and upside scenarios. Think in ranges, not single numbers. Third, look for margin of safety. Can you buy in a way that meaningfully reduces the downside? Fourth, consider the optionality. Does the position allow you to change your mind without ruin? Fifth, ask whether the bet aligns with your time horizon and temperament. If you can't live with the mental stress of a plausible loss, you shouldn't take the bet even if the expected value looks attractive on paper. Those steps sound dull, because they are. But dull is cumulative. The person who can do these simple things repeatedly will usually outcompete the person who is brilliant for a month and then blown out by a sudden shock. Make the template a ritual. Write the answers down. Force yourself to produce the downside and the probability. You'll be surprised how often that alone prevents a rash decision. Exit rules deserve explicit attention because they're where human foibles do the most damage. People habitually focus on entry and neglect exits. Persistent attachment to a losing position masquerades as loyalty, as honor, or as commitment. It is usually just ego. Good exit rules are simple. Set criteria for selling before you buy. Those criteria might be time-based if the investment hasn't shown progress in X years, or metric-based if a key performance indicator falls below a threshold, or evidence-based, if a new fact alters the original thesis. The essential quality is that you stick to the rule and don't reinterpret new information to preserve your pride. Pair exit rules with a referee. This is someone whose judgment you trust and who will hold you accountable. The referee can be a business partner, a mentor, or a board. Tell them the rule and ask them to police it. If you don't want to invite embarrassment, you will not get the correction you need. The referee's job is to help separate persistence that builds compounding advantage from persistence that preserves ego. Let's return to examples because they make the abstract concrete. Think of Tom, an entrepreneur I knew who built a tech company with a flashy launch and a spate of early customers. He hired aggressively, raised capital at a high valuation, and chased scale with burn. When growth slowed, Tom doubled down, convinced himself the product only needed a little more marketing, and resisted offers to tighten operations. The market punished that kind of optimism. Cash ran out, investors lost faith, layoffs followed, and the company's optionality evaporated. Tom's persistence was admirable, but it was persistence without corrective mechanisms. He persisted in the wrong things. Now consider Elena, who started a small manufacturing business. She declined venture capital because it required losing too much control and introduced timelines she didn't like. She reinvested modest profits, kept a conservative balance sheet, and focused on steady improvements in efficiency. There were years when she could have grown faster, but preferred the certainty of survival. When a competitor burned cash and folded during a downturn, Elena took a cautious acquisition of useful assets at a sensible price. Her persistence, coupled with patience and a refusal to use leverage she couldn't control, turned into opportunity when others were forced to sell. Those contrasts illustrate the paradox. Persistence beats genius when persistence is applied to durable, survivable strategies. Persistence fails when it becomes stubbornness. The practical difference is feedback loops. Put strong feedback loops in place, and you will persist in the right things more often. A frequent question I get is, how do you train yourself to change your mind? The short answer is, set identity-independent goals. If you define yourself by being right, then every correction will feel like a threat. If you define yourself by learning, then being proven wrong is information you can use. Make curiosity a virtue. Practice saying, I don't know, and follow it with a plan to reduce ignorance. Use checklists. Keep a ledger of your mistakes and what you learned from them. Review that ledger often. People who embrace being learners stay in the game because they are constantly correcting course. Another tool is the pre-commitment mechanism. Decide in advance on rules you will follow when emotions run high. For example, decide that you will not use margin, or that you will cap the size of any single speculative position to a small percentage of your portfolio, or that you will sell after a certain negative signal. Commit to these constraints publicly or to a partner. When the market sings a siren song, pre-commitment removes the need to argue with your impulses. It makes prudence automatic. Systems are equally important. Systems turn judgment into habit and habit into resilience. Automatic savings plans, set rebalancing rules, and pre-agreed hiring criteria are all systems that reduce the tyranny of momentary sentiment. If you are serious about compounding, your job is to make good behavior automatic and bad behavior difficult. You don't rely on willpower. You design your life so that willpower is not the primary defense. Now, some thoughts about quality versus quantity. Too many people hunt for bargains like game hunters search for prey. They feel clever finding cheap assets in problematic industries. Cheaper is not always cheaper in the long run. Buying quality, assets or relationships or businesses that have predictable returns and tolerable downside, reduces friction and surprises. Quality tends to be less glamorous and more durable. It's nearly impossible to make up for persistent small losses through brilliance. Better to buy something that will keep paying you over decades. There's an ethical dimension here, too, that many people miss. Quality often correlates with integrity. A company that treats customers well and invests in its product will be easier to predict than one that relies on smoke and mirrors. That's why reputation and trust compound. Reputation is like capital. You can spend it quickly, but it's hard to rebuild. Protect it. It's part of surviving and compounding. Let's talk about psychological traps because they kill more portfolios and businesses than any external enemy. The first is confirmation bias, the tendency to seek evidence that confirms what you already believe. Actively seek disconfirming facts. Play devil's advocate. Hire someone to argue the opposite. The second is narrative fallacy, the temptation to convert randomness into stories of mastery. Remember, a good story is not proof of a good process. The third is overconfidence born of survivorship. Survivors often attribute success to skill when luck played a large role. Be humble about outcomes and rigorous about process. To combat those traps, adopt a few mental habits. Keep a probabilistic inner voice. When you make a claim, assign a confidence range. When you say, "This will likely happen," think in percentages. That helps detach the ego from certainty and keeps you flexible. Another habit, operate with a margin of safety. Only take bets where the upside justifies the plausible downside. Finally, remember to sleep at night. If an investment or decision keeps you awake with worry, that worry has a value. It is a signal you should not ignore. There's also the matter of timing your commitments. You don't have to fix everything at once. Build your snowball gradually. Start with small habits that compound. A savings percentage, a habit of reading and learning about a field, a rule never to borrow for lifestyle. Those small habits compound into temperament, and temperament compounds into advantage. The path to lifetimes of advantage is not atomic insight. It's the habit of doing sensible things every day for years. Another practical point. Cash is optionality. Don't treat every capital opportunity as mandatory. Sometimes the value is in having the ability to act when others are forced to sell. Plenty of fortunes were made simply by having the liquidity to buy when everyone else had to liquidate. That doesn't mean hoarding. It means balancing deployment with the need to preserve optionality. We've talked about systems, partners, leverage, and exits. Let me give you a short, playable routine you can adopt immediately and keep forever if you want to tilt your life toward compounding. It won't make headlines, and it won't satisfy the part of you that wants quick vindication, but it will build optionality and protect your ability to compound. First, set a reserve rule. Keep enough liquidity to survive a significant shock without selling your core longer-term holdings. Second, automate a savings cadence so that you invest before you have a chance to spend. Third, Write down an investing checklist, your thesis, key risks, the margin of safety you require, and the exit criteria. Fourth, appoint a referee, a partner or friend who will hold you to the exit criteria. Fifth, schedule quarterly reviews where you revisit assumptions, not outcomes. Don't check your portfolio because it went up or down. Check it because your original reasons might have changed. Sixth, cultivate humility. Admit when you're wrong and redeploy your capital and attention accordingly. If you adopt those practices, your life will start to look different in 5 years. Not because of magic, but because you will have avoided the obvious traps that eliminate decades of compounding. You will also have increased your chance of being present when luck happens, because you did not get thrown out of the game on foolish bets. Let me be candid about what persistence will not do. It will not guarantee you brilliance or applause. It will not make you immune to bad luck. It will not turn poor initial choices into good outcomes without correction. Persistence does not beat genius if persistence means stubbornly clinging to error. What persistence does is give you the single most underrated asset: time. Time lets small advantages magnify. Time lets reputation accrue. Time lets repeated sensible choices outpace occasional brilliance. One last practical scaffolding I'd recommend: keep a mistake file. Record the times you were wrong, why you were wrong, and what you did about it. Review that file annually. It's humbling, and that's the point. The file trains you to learn publicly from error and reduces the chance that you will repeat the same mistakes. It also creates a record you can use to spot patterns in your decision-making tendencies. Are you overconfident? Do you take social risks to impress others? Do you underreact until it's too late? Patterns are actionable. We've covered a lot of ground: leverage, partnership selection, decision templates, exit rules, systems for consistency, psychological defenses, and simple habits that translate into decades of advantage. If you adopt this framework, you will have improved your odds not because you found a secret, but because you reduced the chance of catastrophic mistakes and let compounding have its effect. Now, a brief closing example to illustrate the payoff of being boring. Imagine two people inherit equal amounts. One spends, chases status, and invests in trendy leveraged bets. The other lives modestly, invests in durable assets, and continues to save. After a few market cycles, the first person may have moments of grandeur, but is also vulnerable to shocks and runs out of time. The second person is less glamorous, but steadily accrues real options. When the second person is offered an opportunity, an asset sale at a sensible price, an unusual partnership, they have the liquidity, temperament, and track record to act. Time has turned the ordinary choices into extraordinary optionality. That's the practical miracle of compounding. It rewards the patient and the sensible. So, what do you do next? You decide whether you want to be the person who chases applause or the one who survives to take advantage of it. You implement simple systems. You limit leverage. You pick partners who tell you the truth. You set exit rules. You automate savings. You create a mistake file and learn from it. You schedule honest reviews. You guard your reputation. You avoid envy, debt, drama, and fools. You persist, but you do so with a referee, with feedback, and with the humility to change your mind. If this message landed with you, do one practical thing today. Write down one habit you can sustain for 10 years and one exit rule you will use when you're emotionally attached to a losing idea. Share that in the comments or with a friend who needs to hear it. If you want a compact playbook that converts these ideas into daily actions, there's a link in the description for a short guide I put together. No hype, just a checklist you can use. Let me leave you with the central ugly truth wrapped in a challenge. Brilliance is lovely, but brilliance that burns out leaves nothing to compound. Persistence, when guided by rationality and humility, becomes the engine of real advantage. So ask yourself, will you build to be the person who survives the decades or the person who dazzles for a moment and disappears? Which will you choose, the flash of genius or the steady battery that keeps the lights on?